Hello, and we are live. We are live, guys. This is the first live webinar for Cycles, Trends and Forecasts for lifetime members. I've been told by the technicians that we've got a number of you that have already joined us, so really welcome. It's great to have you here. And Catherine and Callum, welcome. How are you doing?
Oh, good. Thank you, Woody.
Yeah.
Very good to be here.
We've just been discussing how bright this light is in front of us, and we've just been chatting as well for the last hour too. So hopefully our voices aren't too worn out already. Anyway, I was going to do a bit of an intro, and I was going to ask you a few things to do a bit of a market update and all that sort of stuff. But we have been inundated with questions from you guys, so I figured it's best to probably just get straight in and ask you some questions. So the first one, which I thought would be good, it's about timing the cycle. It's from reader Michael, and he asked, was the sudden crash in March 2020 the mid-cycle slowdown? And will we see another slowdown in the stock market specifically? So I'm going to ask Cal about that one prior to the end of the cycle downturn in 2026. So how about we start with the land stuff, Catherine? Was the sudden market crash in 2020, was that the mid-cycle slowdown, do you think?
That was a mid-cycle slowdown, and the mid-cycle is always more of an event that you will notice on the stock market than you're going to notice in the land market. And that doesn't mean that the land market goes exponentially for the entire 14 years up. We always say it's 14 years up and it's 4 years down. And but that's just it just averages out. It's just about that. You know, it can be a little bit more, it can be a little bit less when the land prices peak. But it doesn't mean that you go up and you don't have some kind of leveling out. And really, our leveling out came before the 2020. Mid-cycle.
I remember you telling me, because we were talking about the property market back then, and I think that was at the end of 2019. And then something always happens to whack the whole thing out around, you know, and the pandemic comes along.
Yeah,
and accentuates it.
That's right, but land had been deleveraging before the pandemic, so you'd had it peaking around 2017, and then 2018 you had the biggest downturn that we've seen for 30 years. I say downturn, I mean, it's measured by the median price, right, going down, and the median price is just a middle figure of a bunch of sales. But individual property prices really took a hit at that time because there were no buyers around. So there was a lot of deleveraging, there was a lot of restraint in lending, there was no development that was going on. So really that if anything, for the land market was more of a mid-cycle slowdown, if you like, and then of course, you know, you kind of push it up. I talk a lot about you know, I've spoken a lot about this in Cashmore's Real Estate Wealth. So, you know, more in that product than I have so much in Cycles, Trends and Forecasts. But when you look at land prices in Australia, you get around a period of anywhere from 4 to 6 years of very strong growth. And then you always get a period where it levels out. And that will either be at the mid-cycle or it will be at the end of cycle. For land, I'm talking about, not for stocks, right? So the mid-cycle, you know, for land. So it's not unusual. You can't get a period where you've got double-digit growth going for the whole time because of stuff that will happen. But the mid-cycle really is a stock market event. It's something that comes out of the blue that's unexpected. We obviously thought it was going to be milder. We were talking about the mid-cycle's not going to hit too hard, but yeah.
Well, so is there going to be another one? So that was the second part of the question.
You mean another big collapse like we saw in 2020?
Maybe, or another slowdown between now and the end of the cycle.
I don't think so. Definitely, I mean, we've got 5 years till 2026, so there's going to be other scary moments, and there's going to be lots of volatility, and there'll be other things that spook us all. But I would be staggered if we saw a collapse like we did in March or into March 2020, until we get to past the peak of this cycle, and then if history repeats, we'll get something like that. But in between, I would not expect to see the violence and the volatility that we saw around that time again.
So there you go, Michael. We do have another question, which is kind of related to that, from Alex. Does the COVID-19 pandemic change the timeline for the current booming upcycle to 2026? Does the pandemic itself change anything about the cycle?
If anything, the pandemic has just made it far more inflationary. We were talking anyway in the lead up to the second half of the cycle that this cycle was going to be the biggest land boom globally that we had ever seen. And you could say that based on what you were seeing in the charts and the figures. And each cycle anyway is bigger than the last cycle. It's just the feature that you've got of the credit creation against land. You could not have conceived what was going to happen to the land market based on the pandemic coming in when it came in. It was very difficult to see how that was going to cause even more inflation in the land market than we were expecting. But in 2019, December 2019 was the first time that I featured the charts in Cycles, Trends and Forecasts, which had come from Philip Seuss that he did. And he sent me these charts that were very well correlated. You'll need to look back, anyone who's watching will need to look back into the monthly from December 2019 to sort of see what I'm talking about. But it looked like there was going to be this massive boom in Perth, in the Northern Territory, in Queensland. You know, you kind of got these big booms happening, and it was difficult to understand exactly how that was going to happen against Perth just starting to pick up pace and everything. So we were talking about these things were going to happen. It was just difficult to know how. There's only one thing that can stop the land cycle playing out against the 18-year cycle as we've timed it. And that is if they collect the rent from land.
Or some kind of massive war or something, right?
Oh, war. But if you look back at when the wars came, they came typically at the top of the cycle, because that's how the cycle of war basically works. It's war is a war for minerals, for the stuff that fuels empires, right? So territorial, chasing resources and so on and so forth. So the wars basically came at the peak of the cycle, as you would expect. It doesn't mean the war actually is, and again, I've written an update on it in a weekly, I think I mentioned it, that you've got war anyway time within the cycle between 2023 and but you would expect it to, when you're approaching the top of the K wave, because that's...
We've got questions on all these things.
I was going to say, I saw a headline just the other day about how they might be looking for rare earths on the moon. Did you see that?
Yeah.
Of course, the race is on to get to the moon then, right? To get what's up there. So that's where it's going next, right?
Yeah. Well, that's, yeah, we've written, we'll say, well, we've written about that. Another thing we've written, yeah, about obviously, yeah, mining the moon,
But
the race to get on.
You mentioned the inflationary pressures. Now that we were talking prior to that, we flipped on, our technician guys flipped on and we went live. That is the most pertinent question today, and you were very keen to talk about that. And we actually have a question from Eric, which applies to both the stock market and the property market. First of all, he says, many thanks for your great newsletters. So well done, guys. He's transformed his understanding of economics and real estate. It actually has done to me as well, Eric, so you're not alone there. But he asked, how do you see the escalating scarcity of raw materials and inflationary pressures in general around the world impacting the property cycle and stock markets? Or does it? How would you answer that one?
We were talking about it against the background of how the economy runs. And we have a monetary system that is based on inflation. You need inflation for the way that the current monetary system is structured in order to keep things going. So that's why you've got, you know, all the money printing that's going on, pushing out money. It's based on this fact that GDP grows and you've got inflation, 2% inflation. So hyperinflation is bad, but a little bit of inflation is good. And that's kind of how things run. But it's set against exponential deflation, which is happening in technology. So we have the biggest technological boom that's happening with unbelievable pace of technology. And in terms of the land, I think the question that one of the questions that we had there was talking about, well, you know, with 3D printing and everything, does that affect things? Anything that becomes deflationary, that goes against land. So, but as it becomes cheaper to build properties, for example, the land price takes the gains of that, because the land is the one thing that is scarce in accessible supply. So we have a lot of land in Australia, but we don't have a lot of land that is readily and easily supplied that people want to live on. And so in the places where people want to live, if you make things cheaper in order to build, it has a deflationary, so the prices go backwards. But it doesn't go backwards in the land price. The only way that the land can deflate in value is if you tax the land, because the taxes away the economic rent of the land. But ultimately, you know, we're in a deflationary environment as far as technology is going. And that's just encouraging governments to print more money, to push towards a digital currency so they can push towards negative interest rates, which is only again going to be more inflationary for land. The other thing I think to take into account with obviously, I've spoken a little bit about this in CTNF as well, about how digital is changing everything when it comes to the land environment, the way that you purchase land, so allowing people fractionalized investment into land, allowing land transactions to be done instantly in real time, and then opening the land market up to Bitcoin, which absolutely has to happen. It cannot not happen. It has to happen because of the way that Bitcoin is taking off. So the blockchain is changing everything about land. And then we were talking about digital land. I was kind of like seeping into that. But ultimately, all of these things anyway, your access to the internet and your access to Wi-Fi and your access and everything that we have around us. So for example, you can say, well, where would 3D printing go? Would it be that in the future you imagine, oh, look, I want a table, for example, and what you would normally do now is go to the local furniture shop and look at tables and choose one and then get it brought to your home. Whereas in the future, what you could happen, right, is that you can choose a design and digitally print your own table there and then. So it's a deflationary kind of environment. But ultimately, everything that is around us is made from land as well. So it makes the commodity of land and the stuff of land in a very inflationary in an inflationary environment.
When you say technology is a deflation, that plays out in the stock market, right? Because if you parallel, say, to, and I'm just off the top of my head, back in the 1920s when Henry Ford was creating his cars, that was a new technology, and what he was doing was bringing the price of cars down cheaper. It was a deflationary technology, and you see that,
and a disruptive one,
yeah. And you see that now with technology companies. What you want to see, laptops, for example, the prices come down. It's a deflationary thing. So how does it play into it?
Well, just remember the question was, how does the inflation of commodities, right? Commodities going up. So
correct. Yeah.
If you're a laptop producer in Japan, right, you don't want high commodity prices. But we don't have much value add like that here in Australia, but we produce commodities, right? So the idea is that it's good for us here in Australia. So mining companies will increase their earnings. So if you're mining copper, then you want a higher copper price. But if you're an end user of copper, you want it to go down. So the profitability of the mining industry here is going to feed into the real estate cycle. That's one reason why we're so excited by Perth.
We actually have a question on Perth. We've got questions on all these things coming up. But the other part of Eric's question was, will this bring forward the end of the cycle, or is it within expectations?
Well, I would say that it's within expectations, and that's just based on the historical reliability of this cycle to pick where you're going to have where the recessionary points in the cycle are going to be. And the expectation for that. There's nothing that I can see that would disrupt that unless they... The only thing that threatens the land market, of course, is to change legislation around land.
Is that
so to take well, the reason that it cannot happen is because the monetary system needs to have an inflationary land environment in order to lend money against it, to lend money against the collateral, the chosen collateral, which is land. And so they won't touch under the current system that we have. They wouldn't stop that. They need you to invest in land. And so that's, one of the reasons why we talk about that it's almost a bulletproof within the upward phases of the cycle, because you know that it can't have exponential growth in that. You just can't do it because you can't afford the debt. At some point, the debts are going to rise above people's ability to pay back the debt. And so that's why you would get the crash at the end of the cycle. And it's not only that, but the fact of, technology is great. Technology is always deflationary, right? Because you have more time to do things that, you now, we don't need people to come and see us talking, right? They can sit at home and see us talking. So they're saving a lot of time in order to do that. And the technology is part of it's free, basically, from that travel time. So of course it's deflationary. But the monetary environment, because the monetary environment is inflationary, I lost my train of thought for a second there, but the monetary environment is inflationary. You've got to have land prices going up. They need land prices to go up.
So this talk in the news at the moment about how central banks might be forced to raise rates. is that a smokescreen? Is that something that people should actually be wary of, or is it because that suggests a slowdown, possibly, or is that just feeding into the second half of the cycle up until the 2026 peak?
Yeah, the end of the cycle is always featured by an increase in borrowing costs, because it's at that point that normally the legislation around it is specifically to slow the land price, and the economy is going better, and people have forgotten the previous downturn, and so. But at the same time, this is what I was trying to say before, and I said, I love my train of thought. I knew I'd kind of lost where I was going with it, but it would just be after the amount of time we've been talking here. But the thing is, it's a damaging system, right? Technology is a good system because it makes everything deflation. We don't want an inflationary environment. Inflationary environment robs you of your money. And so the monetary system, everything is breaking down around us. The people are losing their trust in the monetary system, and that's why they're ploughing their money even more speculatively into land. And I think an inflationary environment just makes people do that more so, because they're spending money quicker in that environment into what they see as assets that are protect their wealth. In terms of interest rates going up, that they go up at the end of the cycle, and so that would be around the end of 2023. You see it, but I think, Cal, we were talking about this earlier. Do you want to say the bit where you?
Yeah, well, I'll just say there's a couple of points we can talk about rising interest rates. So we have it all drilled into us, right? That when things get bad, they lower rates, and that's a good thing, right? That's the theory. You lower rates and you get things moving again. The point, it's just a theory. You cannot find a study that says this proves that this works, but they just keep going on about it all the time. So there's a guy like who's studied this for a long time, and he talks about if you actually wanted to engender a strong recovery, you raise interest rates. And the reason is it gives banks more incentive to lend because they get bigger margins and higher returns on equity and that type of thing. And then because they're increasing the money supply, you get more economic activity. So you don't have to be afraid of rising interest rates if it's well forecast and the market starts to price it in. It won't cause great damage. The thing to watch is what the private banks are doing. We always go, oh, what's a central bank going to do? What are they going to go and do? So we have to watch what the private banks are up to. And you could grab any of those big four chiefs and they say, give us higher interest rates. Their return on equity is going down. The old loans that had higher rates are getting paid off. So it's making them weaker, as it were. And I should say, interest rates follow growth, right? So if we're getting rising interest rates, and that's what the market's pricing, it means the economy is strong. So that's a good thing.
Was it you, Catherine, that told me that last time, but it wasn't this time, it was the time previously that we were chatting, that at the end of the cycle, you'll notice interest rates going up high, but that actually doesn't dampen down the speculation in property?
Yeah, well, if you look at interest rates, if you chart interest rates anyway in the ups and the downs, for the most time, it's not like it's a correlation where interest rates go up and you get land prices going down. It's the reverse. Interest rates, land prices go up with interest rates. But the thing is, in terms of inflation, I mean, if you think, in terms of inflation, if you think that your land price is going to be rising faster than inflation, faster than the interest rates are going to go up, then it's not that it doesn't matter, but you're going to keep investing in land, right? So, I mean, we still have very low interest rates. You can still fix your interest rates around 2.2%, I think it is about the lowest you can fix them now. And so some of the banks have started to rise variable. But you need to also take into account, just having said that you've got private lenders, the ones that aren't the big banks that are lending, still having a very competitive lending environment as well. So there are ways to borrow and keep your interest rates low. But I mean, if you think that your land price is going to be rising outside of the rate that you're borrowing money, then it still makes sense for you to invest your money in land. Look, there's a whole heap of stuff to go into this. I mean, one of the reasons that we've had so much inflation in land, because our market is rising, the speed of the market, the housing market has risen, is only outpaced by 1989. Which was obviously the winner's curse phase of the 90s, which you would have expected that to happen. Obviously, it was another inflationary environment where borrowing rates were very high. right? And of course, then you got into the 1990s and you went into the end of cycle crash. But the only other time that you've had the housing market rise at such a speed that it is rising now is when the government purposely inflates it through government incentives and government stimulus. And of course, we've had more government stimulus than we have ever had. And there's more money sitting on aggregate in bank accounts than, you know, I mean, it's just unbelievable amount of money that's out there. And a lot of that money obviously is going into land. And that's one of the reasons that we've got such fast rising land prices. And that has not run out, and that has not stopped yet. So when the slowing, any slowing that's happening now, which is around the Melbourne and Sydney market, and I sent a update out today, weekly update, which spoke about that a little bit. The key really when it comes to land investment is to keep picking the areas which are going to be capturing the investment gains that are coming from that.
Well, let's maybe touch on some of those areas. So we had one question from Charlie. What year would it be best to sell up and be cashed up in Sydney? So what do you think about that? I mean, I know you're a big proponent of Perth right now. Is that correct?
Yeah, we pushed Perth. Well, actually, back in 2019, when the market started to turn, based on what we knew was going to happen in commodities. So we could see that the market was starting to turn, and then you just kind of use the logic around that. Perth looks really bullish in a sense because not only have they got the commodity factor, not only are wages being pushed up there because there's not enough workers, they're also encouraging population growth. And in Australia, you need population growth in order to stimulate the land market. So that's one of the things to take into account with Perth. And I think that what McGowan who's the Premier of Perth, was talking the other week, where he's going to put it, once they open up immigration, he's going to do his best to attract immigrants to Perth. So Perth, it tends to start as a slower in the cycle, where the other states tend to go faster. So you see Sydney and Melbourne taking the gains faster and then slowing, and then Perth catching up, just really because of the sales environment over there. But in terms of Sydney, because I'm off on a tangent and not even close to where we're talking the question, Sydney has a history of peaking slightly early in the cycle because it's the most expensive. And if you remember, what happens in the second half of the cycle is that areas become very pricey, and then buyers start to move out and investment starts to go out. And that's why the smaller states by population pick up in the second half of the cycle. That and other reasons. But Sydney is an interesting one. I mean, it's looking now like it's slowing down a little bit, but it has got stuff going for it within the context of what's happening locally anyway. And with that, I'm talking about all the mandates and the restrictions, because Melbourne has a whole swathe of them. So, yeah, it's going to be anyone who ever calls me and says they have a big moan about Melbourne and legislation around what's happening in Melbourne. But Sydney's got rid of all of it. I mean, Sydney's a very different economy, handled itself much better, hasn't had as longer lockdowns. Obviously, they've got no mandates there, so they're not restricting unvaccinated. Now, you imagine if you're an unvaccinated tradie, and there's quite a lot of them that I know personally in Melbourne, who are now moving. They're moving out of Melbourne to places where they can work, and so that's stimulating more population growth in Sydney.
Like you often say, never sell.
Yeah. I do. I say never sell because you lose money when you sell.
So in Sydney specifically, or
anywhere?
Anywhere, yeah. I mean, the reason that I say that is because you use your property as essentially your bank account, right? So you borrow against it. The bank lends against property. If you want to go and get a business loan, right, they're not going to give you a business loan against your car or your coffee table that you bought. They want a really nice coffee table. Well, you might have bought a really nice. Yeah, I've got a really good one at home too. Yeah, but they're lending against your land. Your land is your collateral your leverage, right? Of which the government backs with its policies and goes up in value. So I mean, the best way to play the land cycle is to structure your portfolio so that you earn your. I mean, I always talk about the base of your portfolio should be your wealth making from land, the subdividable block, which I always talk about, because that's the thing that attracts the greatest capital growth. You borrow against it, you leverage up in the boom phase of the cycle, and you make sure that you're in a decent cash held position when it comes to the other phase of the cycle. And the only time that you would think of, selling that land is where you need to restructure yourself into a position where you perhaps don't want to finance anymore. The other thing I should say of that, of course, is that because there was a question in there about borrowing. I can't remember exactly what it is, but it was somebody that was as a older age group, and they were saying that they having problems financing. They own land, having problems financing against it, and because the banks want you to have an income in order to lend.
Yeah.
And so that's where you would need to explore other rounds of financing. And I'll get an answer to that. Yeah, it does. I mean, it obviously depends on your personal situation, but ultimately you don't win when you sell. You win when you.
So maybe we're kind of related to it. For people who are retired and own multiple properties, would your advice be to sell during this boom, or will there be opportunities to buy back in?
Yeah, I feel like it's a personal advice question. You need to structure yourself so that it depends what you want to do. I mean, if you want to sort of get to the end and you're cashed up and you retire, then your portfolio is going to look a little bit different than if you're building up your wealth and you've got income in order to keep borrowing against it. I mean, obviously, when you're going into retirement, then that might be that you're selling off some of the land and you're paying down your debt, and then you're ending up in a position where you've got land that's still appreciating in value, but you've also got good cash flow that's coming in from that. So it might be a portfolio that is structured from positively yielding properties, or which we should go into that. There's so much to talk about, isn't there? But also, maybe you've got commercial that's in there as well. So there's nothing wrong with selling down. It's not necessarily that you have to time the cycle. So timing where the peak of the land market comes is actually very difficult, and to time a sale for the peak of the land market is very difficult. I have a lot of questions about this, and subscribers will be getting soon a special edition, I think, on timing the peak, because that's one of the you're right, things that we did do. But it takes a little bit looking at the land indicators on the ground in order to time it. But for the Sydney question, because I don't feel like I've rounded that off and I'm just going off.
No, you go.
There, everywhere. But the Sydney one, what I would be looking for is, I mean, there's a slowing down that's coming in Sydney, but I don't know necessarily that market has peaked. And I think it's got a little way to go, because I think they will pick up on population growth and people will be going to Sydney. And remember,
quite a bit of infrastructure stuff happening too.
Yeah, there's a bit of infrastructure stuff happening. But the thing I was going to say is, remember, we've got the immigration gates to slowly start. I mean, that's not going to ramp up fast, but that's going to slowly start to open. And I imagine that Sydney's going to pick up quite strongly.
Well, there's one observation here, is that rental yields in Melbourne are lower than in other locations. Is that part of it? Is that a sort of an exodus of people kind of leaving Victoria, basically?
Yeah, so I mean, that's another. This was the really good forecast from those Philip Seuss charts, because it forecast everything that we are seeing now was in those charts that he did, which was, after a couple of years, you would see Melbourne and Sydney start to slow, which is what we're seeing now. And low rental yields in Melbourne is a problem, because the prices were pushed so high in the first half of the cycle. You do have low rental yields, but you've also got another problem in Melbourne, and that's people leaving town and selling. So we've now got an increase of stock in Melbourne. There are places in Australia, my choice, right, even though I'm kind of shooting myself in the foot business-wise, right, because obviously I'm located in Melbourne and I help buyers buy in Melbourne. So unbiased advice coming out, but my choice, depending on how long, if you want to buy now and sell at the peak of the cycle, my choice wouldn't be necessarily to buy in Melbourne. It would be to go elsewhere, and I would be heading either to Southeast Queensland, or I'd be focusing on Perth. And Perth is a little bit more speculative, because it doesn't necessarily correlate exactly with the 18-year cycle, because it's a commodity town. And so there's been periods in Perth's land cycle where it has overshot what's happening in the eastern states, and one of those was in the 1890s. Obviously, we were going through a massive depression from the gold boom, and they were finding gold in Perth, and you had land being subdivided in Subiaco and the government selling off, a massive land speculation going on there. It's a little bit more synchronized now than it was then, but that's what I would advise. And if you do that, there's going to be areas in those states and elsewhere. I mean, I shouldn't forget that South Australia, you can also get this too. It's very much a localized thing as where you buy, but there's going to be areas in those places still where you can get land that is gaining good capital growth, and you can still get neutral to positively geared rents. And that's almost, to me, a gold mine, a no-brainer to invest in that and to hold until the end of the cycle. And of course, you've got the Olympics that are coming up in Southeast
Oh,
Asia.
that's even another question, but that's awesome, Catherine. Callum, just a question on the stock market. So you're big on commodities, right? That sort of plays into a little bit to what Catherine was just saying. Is that what you're seeing? Like we were discussing the other week that you're looking at the REITs and you're also looking at commodity plays. I think banks too, but
yeah, well, finances, yeah. So the question is
no particular question really. Yes.
So yeah, commodities. So we're just talking about Perth, right? So even now, iron ore is $100 a ton, right? It's still very profitable. The gold miners, the stocks themselves have been a bit of a dud this year, but they're actually extremely profitable businesses. And I was chatting to Shay this week for my podcast.
Our old mate
Shay, right? So she was at a mining conference and she was saying the feedback is they can't get people, right? They have to pay big wages. But because they're making so much money, they can sort of wear it for the moment. So yeah, it's very bullish outlook. Then we've got the lithium industry, just exploding over there. Copper, all the things we hear about, nickel, most of it's in Western Australia. So it's wildly bullish. So there's been heaps of opportunity in mining stocks this year, and I don't see that slowing down. It'll be different commodities at different times, and the way the market works. But yeah, it's got lots of opportunity, and so the yields on the big iron ore miners, they're huge at the moment. Now we can't guarantee it's going to stay that high, but the outlook for infrastructure and steel around the world is still really bullish. So just think about it, that all this scare stuff that we had about China, right? The Evergrande and all that, the price of iron ore is still higher than the last 5 years. Like it was so high before, crazy high. It's still actually very high. So there's lots of profits and lots of dividends going in.
You mentioned Evergrande. We got a question from Jude, actually. She says, recently we've seen high-profile developers on the brink of going under. She mentions Evergrande, ABD Group. Are these signs of the end of the cycle?
Not at this point. And so that's really where the timing of the cycle becomes very important to understand when the end of the cycle is coming and then read the signs within that. The developers going under, I mean, you're going to hear more of that anyway in Australia based on the building material shortages. So the manufactured shortages through the COVID pandemic of building materials. And then you've got developers that cannot finish jobs. If they can't finish jobs, they can't get paid. And so then you've got problems with that happening with developers. And yeah, I mean, it obviously affects things, but it's also counteracted by what's happening in the technological sphere with that. So, I mean, I wrote about this in last month's update, but these things are really, I don't think people realize how big they are. But I mean, in terms of the 3D printing, for example, for property, one of the big issues with 3D printing is getting it across regulation. So our regulation systems are archaic, just like our monetary system is archaic and our forms of government are archaic, and they're slow, and it takes a long time to get legislation passed, and it takes a long time to get these things passed. That's all going to change with the digital revolution that we're seeing now. But one of the issues with 3D printing and why we haven't got over this problem and why we don't 3D print with things like hemp concrete and these materials which are in abundance here is to do with legislation. And in Germany have the most restrictive building legislations in the world, and they've just got across that with their first 3D printed house. And now we're breaking through the legislation. You're going to see that take off a lot more. So where people are losing money, the innovation within the industry is going to lead people to make money. With Evergrande, obviously, we're looking at something that is in China as opposed to something, say, that would be in America, where you could see that the bank lending against real estate and how it's structured in America would lead to a destruction of the system, if you like, and really would lead to big losses. With Evergrande, obviously, you're in China and things work a little bit differently in China, and I don't see that pulling apart the whole system. No. And in fact, of course, it hasn't so far. We would expect that to happen, and I wrote a weekly update not so long ago, just 2 or 3 weeks ago, where you would expect things to happen like that at the end of the cycle. At the end of the mid-cycle, because if you go back into the mid-cycle that happened in the last cycle around 2001, you had quite a few panic events that happened around that time, and there was a bottoming that was always going to come at the end of this year, based on the cycle. Again, I wrote about it in the edition I did on the decade cycle. So, you know, we would expect, you know, events like that to happen. But one of the things about China and the way that land is, there's not, you know, China taxes away. It's a completely different system, the way China handles its land. It's still, even though it doesn't capture all the uplift of land, there is obviously the land tax situation in China through the leasing of the land is very different to what we have here. And they're trying to deleverage their property system anyway. They're trying to do the reverse of what's happening, you know, in America and what happens.
Well, they don't mind US companies getting into trouble, do they? So what about just one more question on the timing of the cycle? Could the things that are going on, for example, might the cycle lengthen a year or more due to private sector economic reactivation being muted or delayed? So, or could it be shortened by early government interventions, for example?
The cycle can only be changed, right? Because we're talking essentially, well, look, it's an 18-year cycle that land correlates with, because the 18-year cycle is evident.
But it's led by the US, though, right? We've got to remember as well.
Well, US is because the US is a massive dominant economy and the way that the monetary system works. So that's why it's, you know, the credit cycle works basically. In terms of the cycle pulling up early or anything like, or pushing out, there's obviously the things that affect the cycle are to do with policy. And it comes back to the same thing again. If you've got, depending on the level of speculation that goes into land, will depend on the amount of boom that you have within the cycle. And that will specifically show itself at that point at the end of the 18 years. And so, you know, that's why, you know, previously I've written about what happened in the last cycle, for example, in America, where you had some states where there was a lot of speculation going into land, like Florida, like LA, and then you have a massive boom and a massive burst. And then you have other states where a lot of speculation wasn't going into land because of the land policies in that state. So you barely noticed in the land market that there was a bust at the end of the 18-year cycle, because in Texas, for example, with Houston in particular, where they have policies that really deter speculation in land, you don't get a boom, you don't get a massive bust. And even though a lot of people had subprime loans in those states, it didn't affect things like you would expect it. And so whether the cycle gets pushed out, I mean, we managed to do it arguably, right? Because we still have the downturn in 2008. I was working in the real estate market in 2008, and I remember it because the company that I was working with, we lost all our buyers. They just all disappeared, you know, because they'd lost money on the stock market.
But it was brief, relatively.
Well, I remember it quite acutely because of that. Because the company really went down. You know, we had to give up the office, and there was a lot of things that happened there, and it was like that, a totally unexpected event. You heard things coming up to the end of 2007, beginning of 2008, that everything had gone. You know, we were in recession, and the world was in this recession, and the buyers just disappeared. They stopped midway, so you had no money coming in, and real estate agencies went broke. So it wasn't a good time to be a real estate agent, and I remember that it wasn't a good time to be a real estate agent. But we picked it up very quickly by throwing money at the land market. So if anything, we pushed it out further, you could say, and our landmark prices, after going down, went up another 25% based on the money, the stimulus that had gone in. That was the other time that the market was moving exponentially fast. So 2009 into 2010 was the first home buyers boost, $30,000, $35,000 to buy a home. People rushed into the market, real estate industry picked up, and then it leveled out, went flat, because the other areas of the economy and the stock market and everything was starting to take off at that time. Things were improving. So the cycle can be affected, but it's nothing's going to change the ultimate timing of that trigger point.
Is there, you mentioned, and I know you both believe this, that you can look at the stock market to gauge where we are in the cycle, correct? So do you look at that, Cal, when you're looking at stocks in particular, or like do you look at where we might be in the cycle in relation to what the stock market is doing?
Yeah, you definitely get insights on the stock market. So, for example, this year REITs have risen strongly across the board, right?
He hasn't stopped bragging about that.
So it tells us that rents are rising. Their rents are rising, so their earnings are going up, right? So and like for the industrial sector, you can't get like the demand is huge because of e-commerce and storage and all this sort of stuff. everybody's scrambling to lock up what they've got. So like Goodman Group and that, they're roaring. And so we know we've got a growing, healthy economy. Like rents rise, so that's a good signal.
But that is the polar opposite of what you hear in the mainstream. Like people don't tend to think of really booming, that we have a really booming. We feel like we have a supported one.
Well, I mean, it depends. That's the old question.
I'm saying it's a good thing.
If you're in I'm trying to think of a dud industry at the moment, like a restaurant or something, you're in a depression, right? But it depends where you're at. But this is part of what makes the cycle so good. So, as I alluded to earlier, the mainstream constantly gibbers on about the RBA and interest rates when it's much more useful, and the cycle teaches us to watch what land values are doing and what bank credit is doing, and both are going up at the moment. So, I don't sit here worrying about the stock market collapsing on me because I see those two things going on. It doesn't mean it can't go down or get volatile, but if it was the reverse, then I'd be worried.
Gotcha. That kind of answers Jeff's question, actually, and that is how closely is the share market related to the property cycle? I guess that answers that question, doesn't it?
Well, yeah, it depends. Like if you're looking at a specky stock that might, be in the medicine or cannabis industry, it doesn't necessarily have anything to do with property. But Australia is such dominated by real estate. So we've got, builders, banks, real estate agents, retailers, they all feed off property in one way or another. So it depends what industry you're looking at, but absolutely, they're very entwined, and you get insights from both.
It's amazing to me how, like, just a personal story. We recently had an estate agent over to just check our place out. Not because we were willing to move, we just want to get the lay of the land. And I just casually asked her, "So do you know the 18-year cycle?" Literally no idea. Why is that?
I can tell you exactly why. I've done a real estate course, and I think it took 1 day. It took about 1 day, 2 days. It was a while ago.
It took longer than 1 day.
Well, I reckon it took about 1 day.
I think when you did it, it takes longer than 1 day now.
Does it?
Yeah, it does.
It's in Victoria, maybe. We have the best they told me. Anyway, all I wanted to say is you learn absolutely nothing. You learn absolutely nothing about anything that we talk about or anything in a finance newspaper. It is simply about the legality of transferring a title to somebody else and making sure you fill out the little form correctly. And, I'm taking the blinds with me and I'm leaving the washing machine. What do you call that stuff again? They've got a name for it. Fictions and fittings, all that stuff. So they're all clueless. And then most of the finance people are clueless as well because it just doesn't come up. The study of land values, it's just, I've been through all the economics books and, Austrian economics, MMT, neoclassical, blah, blah, blah. They all miss it. It's just incredible.
The thing is about the stock is that land makes, if you look at the stock market where you haven't got land speculation, you're not going to get such a volatile situation. So again, one of the things that we've written about in an update. But if you look at it, land makes up a lot of economic rent is a big part of that's what's traded in the stock market. And of course, it works the other way around. So, I mean, it causes much more volatility in the stock market. And obviously that, feeds into everything that we're talking about here. But
I've just seen another question from Rex. There's a few questions on there. One of them touches a bit too personal advice, so I'm going to leave that one. But he does ask about REITs. Is REITs a good option to take advantage of the second half of the cycle? I guess the answer to that is yes.
Yes. I mean, again, it depends what you're looking for. If you're looking for income and sort of a steady, slow burn, ride the cycle for 6 years, way to go about it. And you can finesse it. Like there's different sectors of REITs. So, as I said, probably this year industrial land's been the best, but it might be different as we go along. But you have to be that type of investor, looking for income and happy to ride along and ride the dips and all that stuff. If you're looking for fast-paced gains, then they're not necessarily going to be the one to follow. But absolutely, for the second half of the cycle, they own the properties or huge land banks, and they can develop it, grow their earnings, do all sorts of things. So absolutely, they're a sector for the second half.
There you go, Rex. So good. Yeah, go on.
Well, I was going to say with the other questions, because there's a lot of questions that have come in about what the properties that people own and everything. So, I mean, you're welcome to send. Some of them are difficult to answer because they do Well, they touch
What
on
what
the
we are
personal
going
situation.
what we are going to do is any question we don't answer today, we'll take note of it. And Catherine, I promise you, we'll do a special video straight to camera, just discussing.
Or if you want to reach out to me an email, like send me an email with a question, and I always do my best. And anyone that's dealt with me knows is to try and get back to everybody if you shoot me an email.
No, you are very good like that.
I'm very good like that.
I have got a question from David, and this is something we were really discussing earlier before, and it was one of those discussions where the camera switches on, and we're like, oh, wish we were recording this. So it's a question about crypto and how that plays out over the rest of the cycle. Will it feed into the price of land and land values?
Yeah, well, I mean, I think it's a little bit of what we touched on earlier with crypto and with Bitcoin and how Bitcoin is becoming. Look, I mean, I'm not a crypto. Obviously, I'm not the crypto writer. But the thing is, we were talking about, in terms of the monetary system's broken. It's broken because the monetary system relies on this inflationary growth, and the more and more money that's being pumped into it, and the more that people's, it's savings are being degraded away, and money's become worth nothing, and so you've got all these other things, and then we have basically, because of the technological boom, we have a deflationary environment, exponentially deflationary environment, not an inflationary environment. The inflation that's happening is a manipulated inflation that's coming from the money printing and coming from the supply shortages, all of which have been manipulated on the back of COVID.
We were talking earlier today about Bitcoin potentially becoming a bigger part, but would that change the inflationary dynamics of the cycle, though?
The only thing, there's been all sorts of talk about monetary system. Before Bitcoin came in, you sort of had the idea that first of all, people had to wake up to the idea that bank lending worked, which happened in the last crisis, right? So then you had the banks came out and said, oh, actually, we don't need reserves to lend, and this is how we create money. And of course, then you had the modern monetary theorists that kind of came out and said, well, modern monetary theory isn't that you can just spend willy-nilly and everything into the economy like we've got now, but and obviously the more money, there's only one way to stop the investment in land. So when I'm talking about technology being deflationary, because we were talking about Google, right? And then the early days of Google, when it was against Yahoo, and Google was building itself as an engine, and you had to pay to advertise on Yahoo as a search engine. You didn't have to, and Google was free, right? And then Google became really good, and it became the dominant search engine, and it did things really well. And then it started to charge for its advertising, and now it's got this kind of monopoly. And it would be very difficult to challenge that as a search engine. It's happening now because of the censorship that's going on. But it's a bit like with Bitcoin. So you have Bitcoin, which really is the cryptocurrency, which is money with a store of value, and you've got everything that's going on about it. It's very difficult Bitcoin has become very big, and there's no stopping it. You can't stop that kind of revolution. And the sooner the system catches up with it and realizes that, rather than trying to now force us onto CBDC, which will happen, and of course they'll push rates, central bank digital currency, and then that will enable them to push rates negative to keep this growth going, to handle the debt, and people won't be able to hoard their cash or anything out of it because it'll be taken out of the system. So, I mean, ultimately I see Bitcoin as being very bullish for land, like I see everything else as being very bullish essentially for land. Because we can't get away from the fact that we need land to make the physical things that we need. Right? So it's a bit like digital land. Digital land is, it's great in one sense because you've got kids that have grown up playing, we probably can't relate to because I don't play any video games or anything like that. But you've got kids that have grown up, in Fortune, is it? I have no idea. Yeah, but they've grown up basically in the digital thing. But
I'm really good. I tend to speak now, but that's about it. Yeah, it's easy.
Now you've got the metaverse, right? So there's this idea that the metaverse is going to take over the internet, and people are going to spend their time. We've got big digital goggles now, but it probably won't be like that as technology goes on. You'll spend your time, we'll be meeting virtually and out with our avatars. And so because the more time you spend in the metaverse, then obviously you've got digital land that then becomes worth something because there's places that you go in the metaverse. Well, that's already right? Happening. So that's already happening. Yeah, there's a lot of money. I wrote about it in DR the other day. So there's a lot of money that's being made from digital land. But at some point, whatever you do with all of those things, ultimately it is land and location that fuels them all, whether it's the internet, whether it's your ability to physically get on a plane and go somewhere, and the air rights that you've got from that, whatever, whether it's the food, whether it's the materials that make the things that are sitting around us now and the things that we're consuming, everything comes from land. And so that doesn't take away the locational value of land. The only thing that can take away the locational value of land is land policy. And that's what will eliminate the cycle. Bitcoin is deflationary, right? So it's perfect for a deflationary environment, which is what we want, right? People don't want an inflationary environment because it robs your income. So I mean, that's kind of what we were discussing. But I mean, all I can see at the moment is Bitcoin being very inflationary for land, because more people that kind of adopt the idea and get used to the idea, the more that you're seeing that landowners now are realizing, well, if they can't sell their land for what they want in real currency, they'll sell it for digital currency. Now that becomes a whole different ballgame in itself, because as soon as you sell land for digital currency, then the whole transaction system changes. It's already changing. When you go to an auction, when I go to an auction, it used to be that we were there for goodness knows how long, right? You travel to the auction, you bid at the auction, you then have to fill out by hand all these contracts, and an hour later you manage to walk away and go to your next auction. Now the auctions, they can happen online instantly, and the contracts are filled out digitally and everything. But once you bring blockchain into it, and you bring buying land via Bitcoin into it or whatever, right, and Ethereum and the blockchain of that into the equation, then everything happens instantly. And so it's even more inflationary for land that I can see it right now, until we get to the point where the locational value, where you tax away the locational value of land.
Don't forget, you mentioned yesterday to me that they're just the pure profits from people who are trading crypto. You know, my good mate, it's just, they're huge. So absolutely, a very bullish.
But that's what is actually allowing a good number of people to actually buy land.
Yeah, without a loan in some cases. Yeah.
Mental.
Yeah. Well, but it's not only that. I mean, I think that the other thing with the digital thing, of course, is that, I mean, this is why the system has to change, because I mean, people have always talked about this in terms of the digital assistant, right? Why do we need to work? Because the digital system takes away the need for people to work. So we wrote in the last monthly update, just as the example, article that Cal sent me, which was Amazon, which is roboticizing their factories, right? So then the factories can create more for the time and the worker, and it's cheaper basically once you've done the build out of the infrastructure. So the thing that's inflationary is the build out of the infrastructure, is getting the materials that you need to make the infrastructure. The same with 3D printing, it's the outlay costs, initial outlay costs, which are expensive. So which is $1 million, buy the printer and everything, get all of that set up. Once you've got it set up, and it's deflationary, right? So
but just think about it too, that the factory becomes more profitable. Right, so the value of that land goes up because it's more profitable, because the robots are more efficient than the average Joe, plugging away.
So once the technology is taken, I mean, this is part of the K-wave anyway. This is how the K-wave works. I mean, the inflationary part of the Kondratiev wave. So the inflationary part of the wave is with the build out of the infrastructure, and the deflationary part is when the new technology comes in, and it creates a deflationary environment. I mean, I think this is what is so counteractive about what you're seeing now, is you're seeing a lot about inflation, and it's really got inflation is just not one thing. I mean, they say, oh, inflation is just prices going up and everything, but it's not caused by, it's a multi-headed beast, right? So it's not just caused by one thing, and it's caused by different things each time. So it's but yeah, I mean, I just see ultimately until you change the relation to location is changing now. I think this is one of the fascinating things that has come from COVID, is that people's relationship to location has fundamentally changed. And so we're already reassessing how we value location. And I don't see that trend changing.
So you don't see people coming back from the regions and back to the cities?
Do you know what? I mean, it's funny because I never would have picked it before. Everything's easy in hindsight, isn't it? Whatever you do.
Well, that's why you've got to trust the, from your point, that's why you trust the cycle, right? even though you don't know how it's going to, what caused the mid-cycle or what extended the mid-cycle slowdown was not a pandemic in the last cycle. It was something else entirely.
And that's, one of the reasons why, you might know the cycle, it gives you some peace of mind, but there's always things that catch you unawares, right? So there's always, it certainly did with me living in an apartment in the pandemic.
We had a chat. We had a chat in March 2020. It was like, wow, could this literally stop everything? I mean, could it?
Well, actually, I don't know whether the subscribers listen, but somebody did write, and I didn't reply to this email, so I'm sorry about that. It came through the admin through the editorials that and they said, "Oh, Catherine, could it be the pandemic that's going to cause markets to crash?" I remember meeting with a colleague of mine in England, Akil, and in earlier that year, and we were sat down, and really we were laughing about the whole thing, like the pandemic, it was just this. And then, of course, in hindsight, you go back and trace all the sway, and because I do a lot of stuff in cycles and astrocycles and stuff, and then of course you can see, and because I went back and did that in terms of the astrocycle, that's why I don't think that things are going to turn around so quickly in terms of where we're going now. But the thing about the pandemic is and anyone watching this will know this, it's changed everybody's life, it's changed everybody's relation to location, because there's a long period of time where we've had to reassess what's really valuable, and what's really valuable are things that have more sustaining meaning to us. So that in terms of the location, people are no longer valuing city amenities like they once did, and they're now valuing topographical things, the ocean, the nature, the walks, the family. So I mean, in terms of real estate investment, that doesn't take away fundamentally what we've been saying in terms of what type of property you want to go for. There's a lot of questions in there about property. I was just going to launch off into something. Can I just? Well, there's a lot of questions in there about property. And one thing I want to say, people say, well, what should I buy? Where should I go? The rule about property is only worth what you can sell it for. Right? So you want to have as broad a buyer demographic as possible that's going to be attracted to that property that you can find. This is why apartments, I always say, you just don't invest in an apartment, because the people that buy apartments is one demographic, primarily investors, and then a dotted about of a few other people, depending on the apartment. First home buyers find it hard. They can't get borrowing for an apartment. So, and then there's there might be a few downsizers that do, but ultimately downsizers don't really want to downsize into an apartment with owners' corporation fees and, whatever else. So there's a lot going against apartments. Whereas if you owned, for example, a single level nice town residence in an area by the bay, good shopping facilities and everything, it's going to attract multiple buyer markets. It's going to attract small families trying to get into the area. It's going to attract downsizers. It's going to attract an investor because they're going to see it as an asset that's going to go up in value. It's going to be easy to rent. So you've already got multiple buyer demographics that are interested in that property. The interesting thing about the pandemic, of course, is it's slightly changed how we think about location. And so that has to come into the mix as well. So recently I've been talking a lot about investing in regional areas. So it doesn't necessarily mean you just go off into, whatever regional area. You need to think all the time about what's going to pull population growth into this regional area, and where is the land that is the most valuable in the regional area. And of course, you need the scarcity factor to come into it, which is why one of the things that with digital land is, would exacerbate a downturn. But the scarcity factor has to come into it as to where you have to have population growth going into an area that is short on supply. And the way that you notice that initially is by the development cycle. And the development cycle leads the property cycle in so much as where the land is starting to get short in supply, the developers will move in, the land will be rezoned, they'll start chopping up the land, population growth will increase, it will start inspiring the councils to invest. So, these are the general rules that you need to really interrogate and really investigate an area. I talk a lot about it in the real estate wealth course, how you do that.
I think you mentioned this, Cal, too, in terms of the REITs, that they have land banks, right? Isn't even that slightly manipulated too, though? Because
developers REITs have land banks,
certain plots where they could just release it.
You're talking about developers, yeah, absolutely. You've talked about that for years. Yeah, they have huge land banks.
The developers have around 14 to 16. We used to do this study at Prosper. We've stopped doing it the last couple of years, but last 3 or 4 years really. But the study used to be looking at the biggest developers, because listed on the ASX, and how big their land banks were that they were holding. Because with developers, it's, you know, with any other industry, you want to buy the goods that you need, and then you don't want to overbuy your stock, right? You want to buy, produce, sell, and you have this thing that going. But because land has got the scarcity factor to it, you know, you want to monopolize all the land. They go and buy up all the land on options, and then they hold on to it. And some of those land banks that we've analysed have been, you know, anywhere from 14 to 18 years land supply at the, you know, very extreme age level. And then, of course, they're not going to put all that land on the market in order to destroy the market. And this is why the supply argument breaks down. The developers are a business, they're a money-making model. And yeah, I mean, that's why
you always hear that in the news. We need more supply.
Yeah, well, and the one thing that they do with we need more supply is that they then call on the government to release more land, and the government rezones more land, which makes people inherently wealthy. The only thing that is achieved by rezoning land here is that the land price goes up. Right? Well, actually, we're about to introduce Victoria. I've written about the Daily Reckoning tomorrow, so you can read that. But a rezoning windfalls tax is going to come in Victoria, which and in the ACT they have something similar. But the idea when you rezone land, it just makes land more valuable. It doesn't mean that the land's going to be developed. So what these, you know, you buy ahead of the best way to become wealthy is to buy land in the path of development. You buy land, you sit on it, you wait for it to be rezoned. And there's whole real estate courses that teach you precisely how to do that. And because the property lobby doesn't like it, because they say, oh, well, it's a discouragement. You can't tax away that. It's a discouragement to development. But it's, yeah, so I mean, you're not going to get, no one's going to purposely crash the market. Not in a system like we have now. They need you to invest in land.
Let's talk, you mentioned the crash in the market. Let's talk about the eventual downturn, because there's a few questions about looking out to 26, 27 and what happens after. From whatever top of the market in 2026, this is Yuan, I believe that's how you pronounce your name. How much in percentage terms do you think that the real estate market will go down? And how does the crash manifest in the stock market? Now, no one knows the future, but let's have a bit of a thought experiment. What do you look back at past crashes to determine what the property market crash will be, and hence the stock market? Maybe you could, I don't know. What do you reckon?
Shall I talk about the property?
You go the property side, and then we'll.
You talk about stock. Yeah. The property market, the crash is always measured by the median price, right? So, and this is actually one of the reasons why you'll get a lot of people, and I've been dealing with one recently who says to me, oh, that property market kind of never crashes, and it only went down.
It doesn't in Williamstown, apparently.
Yeah, that's you hope. It only went down 10% in the 1990s. Yeah. But if you go back and you look at the sales results, which I did, so you look at land that was bought at the very peak, which obviously is not when you want to buy, so 1988, 1989, and then it was sold 4 or 5 years later, you had a halving in the price of the prices. You didn't get that so much, obviously, from if you'd have bought in 2007, you'd have had a dip in 2008. It takes time for the property market to bottom. So it's not like, you know, immediately down. It's a sticky market because you've got vendors selling for all different reasons. Some really need to sell, some will hold out. And so it kind of, you know, tatters its way down. So I mean, I really feel that the next one would be, I really feel that it's going to be a very big one.
Because we're kind of due it, right? I mean,
well,
don't you think, like in the last property end of cycle downturn, it wasn't felt so bad. I mean, it was, but it was kind of cushioned a little bit, right?
Yeah, so it was cushioned a little bit by obviously the government throwing money, but I mean, I really feel that we're heading towards war. So I think there's a whole heap of things that are going to happen. Yeah, so I think there's a whole heap of things that are going to happen at the end of this cycle that could actually affect things. But the point is that you need to be in a position where you weather for whatever would happen in the property market. And then I remember there's a question in there that talks about should you sell? You don't need to. If you look back historically, particularly if you, because this could change with the whole COVID migration thing and depending on, you know, where people go, but land in Australia, in the eastern states anyway, will exceed the previous peak of the cycle in the first half of the next cycle. So you just need to be in a position where you hold, because remember your land. There was another question that came through to me privately about, you know, borrowing, but your land has lost value because the banks won't lend against it. There's no buyers. So it's an on paper monetary loss, but the actual value of the land, of what it is and what it represents, doesn't necessarily lose. So yeah.
What about the stocks, Cal? So how would you, what would you be, what would you be kind of expecting or forecasting?
Well, I mean, it depends how high we go up at that point in time. But you got to remember in the US, for example, the property market topped out in 2006, but US stocks kept coasting up for a while, right? So it takes a while for things to manifest through. So it's possible that the Aussie stock market goes up into 2027 kind of thing. Then it'll depend how big the boom has been and then how bad it gets. But I would expect, 50%. Like if we got COVID, because you've got to remember too, here in Australia, like the state governments are firing all their bullets to prop everything up.
Which is exasperating the end of the cycle boom, right?
So that's feeding the boom now, but they've got red ink everywhere. And then the federal government's going into heaps of debt. And then, of course, when the property starts going down, then the banks stop lending. So everything will be very fragile at that point, and all of us will be geared to the hill. Those that aren't aware of the cycle, everyone will be in debt. And then if history repeats, interest rates get yanked up for something. Maybe it's a spike from oil, or some random thing that they can't control, and everything goes into reverse. And probably at that stage, the stock market will be full of leverage as well, because everybody will have loaded up to buy stocks. So so the thing that we'll have to do when the time comes is you have like a high exposure during what we think is the good phase, and then you slowly narrow it. It'll get smaller and smaller as we get closer to what we think is going to be the peak. But again, it depends so much when we get there. But history shows the worst stock market crashes are real estate led.
Real estate led. And when do you start then looking to be greedy for the next part? And I mean that in the nicest possible way. When do you start looking for opportunity for the next? Then it all starts again, right? The cycle
it does,
again.
But well, theoretically, you give it a year and then you start seeing the price action. But it's not clear to me. So 2008 collapse, sharp rebound from US stocks up. COVID again. It's not clear to me that that'll happen. And the thing that worries me for the next cycle is China. I mean, people are worried about it now, but their population is aging fast.
There's a huge demographic shift.
They've got a demographic thing. And there was a book I wrote about recently. What's it called? China. Anyway, the guy goes through, China has a lot of problems that, not the ones everybody talks about, but to do with their workforce and employment. They're losing employment basically to cheaper countries. So it's getting more fragile as well. Now, remember 2009, they came in with a big stimulus and bailed everybody out by, stimulating. But by that stage, the urbanization will have finished. They're done, basically, in that sense. So, and they'll be fragile as well. So the US will be weak, China will be weak, we'll be weak. I don't know who steps in and bails everybody out that time, but we'll see then. So
isn't that when Bitcoin comes in and saves?
Maybe.
I've got a question. So this is something for me. Now, we covered a lot of stuff, so we're probably going to wrap it up soon. Guys, I hope you don't mind, but I really feel like we could just talk for hours. But this thing called the metaverse, you mentioned it already in this conversation. How does the land cycle play in the digital world? Does it continue there, or is that just something that's a bit...
What happens at the end of the cycle in the metaverse?
No, I mean, does the cycle play out in the metaverse? So will people start? I don't know. Will there be a cycle?
Yeah, I mean, it's fair to say. So the metaverse it's a little bit difficult to visualize unless you've kind of had a little bit of experience with it. But the metaverse has places, right, where people go and people congregate and people meet. And they date and they have work meetings and they go shopping and they dress their avatars. And you can think, like I said, with kids, they're already used to doing this to an extent anyway. So they've been brought up in this age. that means that there's locations in the metaverse that are going to have value. And if they have value and you allow somebody to own those locations where people go, then that means that the price of those locations is going to yield an economic rent. It's going to go up in value. It's going to be something that you can sell for a higher price than you've purchased. And I think one of the things that I wrote about it was someone that had just bought land. He was a long-term real estate investment advisor, and he's just started to buy land in the metaverse because he's done all this investigation about it. And he said, "That makes sense. It makes sense because he's just bought a place on one of the fashion strips, right, which is meant to be equivalent to something in New York, right? And he's bought a place and he wants to make a shop out of it, and he knows that people in the metaverse will come and buy the products in his shop, and there's handbags that are selling in the metaverse. We were talking about it earlier.
Mental.
That are selling for higher,
Yeah.
Gucci handbags that are selling for higher than the real thing. So this is something, obviously it's completely, I mean, you're listening to it, you think it's just utterly insane. It's just speculative mania, but that's basically what the land market is.
Is that where it's going to take off in the next cycle? Is that how it expands and continues?
It doesn't matter ultimately. At some point, we reside in a physical body, right? So at some point you have to take off your VR goggles and live on the land. And it is the land that gives you the food and the sustenance to be able to create the metaverse to go into it.
Yeah.
So it's going to yield a value because people are going to be spending more time in it. And so, it's the money, there's money that's going into that, and people that are making money in that, there's money that's going into the locational value of land that's in the metaverse, the same as there's money that's going into the locational value of land that's here. But of course it works slightly differently from it does here. But I mean, I can just see you've got a massive boom that's going on at the moment because it's all things digital that's riding up and feeding into the land cycle. So it makes that digital land in the metaverse, it makes sense. It's exactly the same as the last real estate boom, digital boom that we had, which was the .com, where everyone was buying place names and trading them for higher and higher prices. And then you had more and more and more of those names come on until you had, obviously the massive crash that happened as the mid-cycle, right, at that point. And and then it became worthless and nothing. And now, half of them got destroyed. So I mean, I see that kind of thing happening. That's got to be a repeat of it. Something like that happening.
Yeah, same. So, is there anything else you'd like to finish up on? Like any message for the subscribers? And
Merry Christmas, of course.
Yeah. Well, look, I hope you've enjoyed this discussion. I mean, look, we don't map these things out. We thought we'd do it live. We'll spitball it a bit. We tried to organise the questions in a logical format. Callum, thank you very much for your help with that. Let us know how you've been. Give us your thoughts on how we can improve this format. I know next time it would be pretty good to get maybe some live questions in. And who knows, maybe when we open up a bit more, we can get a few select people in the room and have a conversation with some subscribers. I've got no idea where these things can go. I mean,
obviously we want this to work, and we want you to be involved in it as much as, we love doing it. We want you to love what we're doing. So write in, let us know how we're doing, let us know what we can do better. And I think it would be good to do a live one where we have live questions and a little bit more interactive.
That'd be great. And the ones that we haven't answered today, we will make sure that we try and get back to you as best we can. Callum, thanks so much, mate. You've still got half a wine to drink, so
won't last long.
Yeah. And Catherine, I know you made me go out walking to get some Pellegrinos, and I didn't find any. No, but I did find a kombucha, but she said no, I don't like kombucha. Anyway, I'll pay back for that. Right. But thank you, Catherine, very much for your time, and thank you for tuning in, and we will see you next time.